Hey guys, so right now we're going to go over Canadian income tax. This video is going to be only about employment income. I'm going to be going really fast. So I'm just going to go over just all the information, whatever. So first of all, there are some sources governing tax law. So this is I should have written this down. So we have the Income Tax Act, which is the statute law. We have common law, which this one actually tells the laws and everything. We have common law, which tells us stuff about definitions and interpretation, stuff like that. We have the CRA, which is the thing that, the body that collects taxes. We have, I think, the Department of Finance. I'm not really sure what they do. I think they what the hell is this? I think they make the income tax laws, stuff like that. So there's that, and then the last sort of source is tax treaties. So these ones would take precedence over the Income Tax Act. Like, for example, if there was some rule here about double taxation, if you are a Canadian citizen but you work in the U.S., who you're supposed to pay taxes to, that's what the tax treaty would take care of. And this one, so that's what double taxation means, and that's what the tax treaty, that's one of the things that tax treaty would take care of. And the tax treaty always takes precedence. It's always more important than the Income Tax Act. So I think the Department of Finance just does income tax laws, so just writing up all the law, stuff like that. So these are the basic sources governing tax law. Next we have, so these are 5 sources of income. So determine income, there are 5 sources. One is employment income, when your employer, the company that you work at, they pay you money. One is business income, so this is if you are a company, I'm not a company, but for example, a company would make money, so what is that what's the business income that they make? Also, if you're self-employed, so if you're self-employed, it would fall underneath business income. Third is property income, so I think this is stuff wait, actually, hold on, I think property income is rent, stuff like that. Wait a second. Yeah, it's rent, stuff like that. Capital gains, oh my god, we literally learned this, but I forgot. So there's it can either be capital gains, whether something falls underneath oh, that's business income versus you know what? Okay, I'm gonna work on this over the next we're gonna go over this in the next video if there is another one. But anyway, capital gains is sort of any, oh yeah, for example, stocks, if the value of stocks increases, that's a capital gain. And then other sources, I'm not really sure what these other sources are. We haven't really gone into those, but they're just other than the up for, I guess. So one thing is the taxation year that's used to determine taxes, determine your income or whatever, is any income that is from January 1 to December 31. This is for individuals, and it's also for professional corporations like law and accounting firms. For businesses though, for normal corporations, it's just any term that's 53 weeks. So they could be from February 1, it can be from February 1 to January 31, or from September 1 to August 31, whatever they want, as long as it's a whole year long. That's their taxation year. I know you might be 52 weeks, but you know how 365 divided by 52 or whatever isn't exactly 7 because of the whole leap year, blah blah. So it's just 53 weeks. Same thing, just a year though. Next we have employment tests. So basically to check if you are employed or if you're self-employed. So to check if your income would go under employment income or business income, there's a test to do. And why is this important? Because the type of income that you get will get taxed differently. So there are these 4 tests that you can do. One is the control test. So basically it's does some other company control your actions, or are you the one who's making decisions? For example, if the company tells you, okay, go to this person's house and clean their house, versus if I were I'm going to go to this person's house and clean them's house, or I'm not going to clean your house, sorry, kind of thing. Who controls a person and their decisions. Next is the ownership of tools. So this is for example, if I have some machinery, whatever, who owns that machinery? Am I borrowing it? Am I using it from the company, or is it my own machinery, and I'm buying it myself, whatever? For example, little hammers, whatever, if I was a mechanic, I guess. The third test is a profit or loss test. So for this one, who does the profits go to and who does the losses go to? So who takes on the risk of the losses? Is it me or is it some other company? If it's me that takes on the risk, then it would be self-employed. If not, then it's the business, a company, then I'm employed. Third is integration. So for example, this is So if there's some kind of like sign that you are like really like you're like really like integrated into a company, like for example, they give you a uniform, you have like a company car, stuff like that. In that case, you're probably employed by that company, in which case it would be employment income. If you don't have anything like that, like there's no uniform, nothing like that, then it would fall underneath, you would be self-employed, and no, this would be business income. Oh my God, I can't believe it's already been 5 minutes. Okay, Jesus Christ. Okay, now we're gonna go over some fundamental rules. So there are 4 fundamental rules. One from the Income Tax Act 5, and this is A, so we'll see 5, 1A. I don't know how, the letters don't really matter too much. Don't worry about those, I guess. Well, for me. So Income Tax 5, 1A, so any form of compensation is taxable on a cash basis. Income Tax 6, 1A. Oh, never mind. I think it was just supposed to be 5, 1. Forget the A. But anyway, Income Tax 6, 1 is any benefits are taxable on a cash basis again. 6.1b is allowances are taxable, and income tax, I forgot the letter for this one, maybe 6.1c or 7. Deductions are not allowed. So the thing about this is that each of these things have exceptions. They have these limitations. So the weird thing about the tax laws is they're like, okay, all your benefits are taxable except for these specific benefits that are non-taxable, or like all the allowances are taxable. Like over here, all allowances are taxable except for like some exceptions. And like all, like for example, you're not allowed to take any deductions except for all these exceptions, which is kind of dumb. Like why are you doing all this? Like also, what's the difference between the benefits and the allowances and the deduction? So first of all, formal compensation is stuff like salary, bonuses, director fees. Director fees are basically if you serve on a board of directors, like you might have like some costs associated with that, like traveling to, I don't know, some meeting, whatever, stuff like that. Those type of fees, those type of benefits that you get, those ones are taxable. Next is benefits. So benefits are, for example, if your company like gives you a car, if your company like gives you some gift, if they like give you some kind of like, I don't know, insurance plan, whatever stuff, they give you some kind of benefit, those things are taxable, except for like a whole bunch of like exceptions and like things that are not taxable. Third things are allowances are taxable. Allowances are basically when the company's like, okay, I'll give you $300 per month. Use this on whatever meals that you are gonna take on the company. Okay, so like any meal up to $300 is on the company, whatever. Third is deduction. So deductions is basically like any expenses. So like what type of expenses can I deduct from my income? What can I be like, hey, like I got this income, but in order to get that income, I had to stay in a hotel, or I had to like use, or I had to, I don't know, or to like do my job, I have my office at my home, and that one, to like pay rent for the office, it's like this much, blah, blah, stuff like that. What type of deductions? Like, that's what the difference between like each of these words are. But like, they're sort of the same thing. It's just like, if you get like a benefit and there's no exceptions or like rules, whatever, against it, then it's going to be taxable. So I'm just going to go through every single, cool. I'm just going to go through every single stuff we have. So the second one is any taxable benefits. So taxable benefits include things like rent-free or low-rent housing, any gifts in cash or gifts in kind. Gift in kind means gifts in kind means any like goods and services that you might give to a person. Not really sure what the difference between like the gift in kind and the non-cash gift is. But like, I don't know, I think it's just in general, just like if you get like a non-cash gift or award and it's less than $500, then it's excluded from income. So basically it's saying like if it's like a small gift, like you're giving somebody like a $20, or like if your employee, or if, I don't know, no, not your employer. If your employer or like your manager gives you like a $50 gift card to some restaurant, I'm not going to put that down on my income and be like, hi, like I earned this much income, because the Income Tax Act, like the CRA people are gonna be like, yo, like $50 is literally nothing, like shut up. So which is why there's like this limit of like $500. But other than that though, gifts in cash are taxable. It's only for if it's like a non-cash gift and award. So if it's like a gift in kind, I guess it would be, there's that $500 limit. Other than that, so we have group term life insurance. So this is a taxable benefit. So there's this one thing where I was trying to figure out like how to remember the rules, right, between taxable benefits and non-taxable benefits. So in general, the only type of like group sort of thing that is taxable is a group term life insurance. Not sure why this term life insurance, so like if I were to die, would my family get my money? Would my family get like this money? I think, why would it be taxable? Hold on, maybe, okay, I'm gonna maybe rule that, figure that out. But other than that though, like all the things are in the non-taxable benefit. Deferred profit sharing. This is like sharing is caring. This is group sickness. This is a pooled thingy. These three things are all group stuff, and these things are not taxable because I think it's like basically the employee has like sort of no control over it, right? Like the employer just does it for you, and you're like, what if I don't really want it, right? I mean, obviously, if you don't really want it, you can just say, hey, like, hi, I don't want to be a part of this. But in general, it's just like the employer is doing it for like everybody, so it's just sort of like a group thing. So it's you don't have to really pay tax on it because it's not like a benefit that you're getting specifically, I guess. What's this thing? Group term life insurance. Group term life insurance. Okay. Other than that, though, any like so holiday trips, prizes, incentive awards for job performance. So if there you get like any type of like I don't know, gift, and this is for a job performance, like for a job well done, you like, I don't know, met some kind of goal, that would be a taxable benefit. Any interest-free or low-interest loans, those are all taxable benefits. And the benefit that you get would be the difference between the market rate and the low rate that you get from your employer. Third thing that's taxable is club dues if there are no benefits to the company. Like, for example, I don't know, you're like part of like some like for example, maybe like your company signs you up for some kind of like I don't know, fun little club thingy and like but it's like a fun club. Like you're not like getting any benefit from it. Like the company doesn't get any benefit from it. In that case, it would be a taxable benefit because it's not like related to the company. The funny thing though is that if we go to tax exempt benefit, if we go to tax exempt benefit, wait, wait, oh, oh, never mind. This is fine. Never mind. Yeah, okay. Well, anyway, so if it's related, if there's like a benefit to the company, then it is taxable. But in this case over here, club dues, if there is a benefit to the company, in that case it's tax exempt, so you don't have to pay tax on it, so it's not a taxable benefit. Okay? So there's that, and then we have cars, automobiles. So for automobiles, there are like these rules like that. Like there's a whole like you have to there's like a operating expense and there's another expense. Those are just like formulas. I'm not gonna write those out just because it's like too much work. Other than that, we have relocation expenses. So relocation expense reimbursement are generally non-taxable. So I should have put it in this section actually. I should have put it in like in this non-taxable benefit section over here at the bottom. But the thing is, there are two things that are taxable. So any cost to finance a home is taxable. Any loss on the sale of home reimbursement is taxable. So for example, let's say that in order to move, I sold my house, but I made a loss of like $200,000. In that case, the company's gonna be like, damn, like I'm so sorry that you had to like pay that loss on like the sale of your home. So they're gonna be like, okay, I'm actually gonna give you the $200,000. So in this case, this is a benefit, right? And basically the rule is that any amount that's above 15K is taxable at 50%. So 200K minus 15%, minus 15K times 50% is how much is going to be taxable. It'll be added to your employment income. Cool. So now we're going to go through the non-taxable benefits. Oh, right, group term life insurance. Is one for which the only amounts payable by the insurer are policy dividends, experience, blah blah blah. What? Why are these taxable? Nay. Is a life insurance offered as an employee benefit? I don't know. Why would this be taxable? Like, what reason would they have for this thing to be taxable? Okay, so apparently one thing is that group term life insurance is convenient and affordable, and coverage is guaranteed. But the thing is, apparently the payout is like really small, like only like a year or two at most. So I guess it's because I guess it's taxable. Oh my God. I guess it's taxable because it's not like that big of a benefit. It's like a small kind of benefit. Whereas these ones over here, like as in like you won't have to, like this is affordable. It's like kind of cheap, so you don't. So like even if they were to tax it, it's not like your taxable. It's not like your income is gonna go up by that much because it's kind of cheap. Whereas these ones over here, I'm assuming that these ones over here are gonna have to like pay. Wait, no, this is employer. Okay, yeah, I guess over here the employer doesn't have to pay too much for you, right? So it's kind of like they're like, you know what, man, don't worry about it. Well, actually, never mind. That doesn't. What? Group term life insurance. Okay, this is a small payout, right? So even small payout, okay, it's a small payout, but the cost of this is very low. So I guess a lot of employers are gonna, be like, let's do this group term life insurance as like a benefit. But I guess maybe if they have to do it for everybody, they're gonna be like, oh, that's a lot. So they're just gonna make it taxable. Then I don't really know why the deferred profit sharing and all that stuff is what's the word? Non-taxable. Maybe, okay, just remember, group term life insurance is taxable, okay? If you ever see group term life insurance, it's taxable. But anything like deferred profit sharing, group sickness accident, and then pooled RBP, also just normal RBP, these are all non-taxable. Another thing that's non-taxable is any private health insurance plan. I don't really know why it's private health service plan. Um, but apparently it could be because of just like politics. Like for example, if like a new party that wanted to get into like a new party that wanted to like gain power was like, hey guys, we're gonna provide these benefits for individuals where any private health services plan stuff you don't have to pay taxes on those, and all the people are gonna be like, yay, and they're gonna vote for them. So I guess that's like one reason why this is like non-taxable. Other than that, what else do we have? So supplementary unemployment. Wait, this is unemployment plan? Oh, the hell? So this is like EI. Oh, okay. Because I read this originally as like employment plan. So I guess this is like EI then, kind of EI premiums. So these ones are non-taxable. Another thing that's non-taxable is counseling for mental physical health for re-employment or retirement. So what I'm getting, the gist of what I'm getting though right now is basically if it's something that's like necessary or like health related or like some kind of like employee advancement related, right? Employee advancement related, these things are non-taxable, like these scholarships, bursaries for family members, counseling for mental and physical health when it comes to re-employment, all these like sort of like these like sort of necessary things like EI, RPP, all these like health insurance plans, these are all non-taxable because they're like necessary. Whereas all these taxable benefits are sort of like bonuses kind of thing, like these rent-free housing and like the gifts and like the holiday trips, automobile, relocation is not like health related, so it's like fine. Group term life insurance, this is the only thing that I'm like a bit iffy about, like why is this one taxable? But I guess this is just like an exception they have to like think about. Other than that, we have some other just tax exempt benefits. I'm not really sure what the difference between non-taxable and tax exempt benefit is. They're like the same thing though. But like anyway, so any discounts on merchandise that you get from the company, any subsidized meals, childcare, uniforms, in-house vacation facilities, like if the company had like a gym, club dues. And this is if the club due is good for the company. In this case, it's tax exempt. You don't have to pay tax on it. What is this? This is internet at this is internet at home. So for example, if your company pays like for your internet at home and it's like all for work purposes, then this would be tax exempt. Any cell phone and computer that you buy and this stuff would be for business purposes are tax exempt. Tax exempt means that you don't have to pay tax on, right? If it's tax exempt, yeah, no tax. Yeah, okay. Then finally, tuition, training costs reimbursed, and this is like for yourself. This one over here, scholarship, bursary, tuition, this was for like family members, whereas this one over here is like for yourself. So like if the company like reimburses your training or tuition costs. And this is if the training was like for business purposes, like if you're like going to like some kind of accounting conference, whatever. So those are all the taxable benefits, like summary. And then we have the next section, allowances. So in general, all allowances are taxable except for some exception. The exceptions here are, these are all general exceptions, by the way. They have like rules within them, so that's like a whole other thing. But in general, any employees that are selling property or negotiating contracts, they don't have to pay taxes on their allowances. I think it's because, I'm not really sure. Selling property or negotiating contracts, this kind of gives the same vibe as like commission stuff. Wait a second. What? Okay. Okay, whatever. I'm not really sure why. So this gives commission vibes, right? Because let's say you're selling a property, you're negotiating a contract. Maybe, okay, just like maybe if you're making deals, if it's like related to making a deal, it's non-taxable. You don't have to pay taxes on your allowance. Other than that, if you are not a salesperson, you don't have to pay taxes on your allowance. Salespeople do though, and they have like some like rules for that. And then overtime, meals, and allowances, I'm not really sure what this is, but I think it's like overtime meals, like maybe if you're like working overtime and they pay you for like they're like, this is the food allowance you can get, I guess. I'm not really sure. But those ones are sort of like non-taxable. So we have a whole bunch of, last section is deductions. Deductions in general are not allowed. So for example, you cannot be like, okay, this is my income, but guess what? I had to pay this much for my car. I had to pay this much for, I don't know, this like binder or whatever. In general, these things are not allowed, but there are, again, exceptions. And these exceptions are the ones you have to like remember for sure. So for example, first exception is expenses from selling negotiating contracts. This is the exact same thing as this one over here. Remember, the allowances are taxable, but this one is more like deduction. Like if you have any costs from selling negotiating contracts, like in this case, it's like the company doesn't give you like a set amount, doesn't give you like $300 and they're like, use this to settle any deals. This is just any like in general expenses that you get from selling negotiating contracts, like out of your own pocket. And this one is for commission employees, by the way, only. So if you're getting paid on commission, then any expenses are from these things are you can deduct them, except there's a limit where the deduction cannot exceed your commission. Like if your commission income was $6,000 and the deduction that you're claiming, you're like, oh look, I have like all the expenses, blah blah, and the expenses come to like $7,500, they're gonna be like, bro, like you cannot do that. Your deductions are gonna be capped at $6,000, the amount of your commission. Another thing is it's not allowed if you have like a reasonable travel allowance. So for example, if your company gives you like $300, like the company's like, okay, you're gonna get $300 per month to make any deals. And it's like a reasonable, I'm not really sure what reasonable means. Reasonable in terms of like traveling, it means stuff like if it's like on a per kilometer basis, like for example, like a travel allowance, if they tell you like, okay, you're gonna get like $4 per kilometer driven, that type of allowance would be a reasonable travel allowance. Not really sure what it means like for negotiating and selling contracts, maybe like per contract, like you get like an allowance of like $1,200. I'm not really sure. Maybe like it could be. But yeah, that's one. Other thing is travel expenses. So these are not allowed if again there's that reasonable travel expense. So for example, the $4 per kilometers driven, whatever. Another thing is you can't deduct as part of the travel expenses here and also as part of like the salesperson selling negotiating contracts thing there. So for example, if like for example, this thing over here, this line over here includes a whole bunch of stuff. Like it includes meals, it includes travel, it includes car and everything. So you can't include that plus this travel expense thing over here. This travel expense here over here, by the way, this is not for commission employees. Like it's not like only for commission employees. This one is only for commission employees. Okay, next. A lot of other things that you can deduct. Things that you can deduct are professional membership dues, like the what's that thing called? The CPA dues, whatever. I don't know. Any types of supplies consumed, like I'm not really sure what they mean by supplies consumed, like I use up like a pencil kind of thing, or like, I think that's what they mean, like, but probably like a bigger supply, I guess, like, I don't know. What's a big supply? Paper, I guess? Printer stuff? I'm not really sure. Okay, that's not even that big. Whatever. I guess if you use up like a lot of supplies, whatever, those things you can deduct. Union dues, you can deduct. RPP contributions, these ones when they are employee contributed, so like you contribute yourself to your RPP, your registered pension plan. In those cases, you can deduct those. Next, we have office space. So if used mostly for employment, like for example, 3 out of the 5 days it's used for employment, then you can deduct everything. So you can deduct utilities, maintenance, rent, and if you are a salesperson, you can also deduct house insurance and property tax. There's also that thing about how you can deduct like cell phone stuff. I'm not really sure where that is, like cell phone and like laptop. Was that a taxable benefit? I don't really know. Okay, I'll check back on that. So things that you cannot deduct, again, like just like the whole like deductions not allowed, which one is not allowed. I'm not really sure why there's like whole this thing. But anyway, things that are like definitely not deductible are any payment for golf, yacht, camp, lodge stuff, any membership fees in clubs like dining, recreation, fitness. I think it's like a fitness club, like a gym membership, recreational thing. I'm not really sure. Maybe like a rec room membership. I'm not sure. And then dining, like if you have like some kind of, I don't know, club and like some kind of restaurant thing. I'm not really sure. But yeah, those things you cannot deduct. These things are sort of like the extras, right? So you can't really deduct them. Okay? Whereas these ones are all sort of like related to the actual, like, related to work. So you can deduct them. Related to work. Okay. And then over here we have some limitations. So to start off, any meals and entertainment. So first of all, meals you can only deduct them if the meal was taken outside of a major like metropolitan city and you were outside of there for over 12 hours. Like you were like far away from home, you could not get home, blah blah blah. And even then you can only deduct like 50% of the meal, which kind of sucks. But also just meals and entertainment in general, you can only deduct 50%. Another thing is your sales expense has to be less than your commission income. So for example, all this stuff over here, like all this deduction that we had over here, like the expenses from the selling, negotiating contracts, like that stuff over there. So if you made like a whole bunch of expenses, that expenses cannot exceed your commission income. So things like meals, promotion, advertising, travel expenses, and stuff like that. Another limitation is cars. So first of all, some limitation that we have is that the CCA maximum deduction is $34,000 plus tax. That equals to $38,420. You might not understand what this is, but if you do like actual CCA problems, you'll understand. So, okay, actually, let's do it right now. So, like, if you were to buy a car, well, not buy a car, if your employer were to give you a car, wait a second. No, that goes under the operating benefit thingy. Does it? Oh, damn. Okay, I just know that if you have to pay CCA, like if you want like CCA deductions, remember CCA is like depreciation, but if you want CCA deductions, and let's say that you buy a car for like 38K, you cannot use the entire 38K as your, well, I mean technically, okay, let's say it's like 38K plus tax, you can't use the entire 38K plus tax to determine the CCA amount that you can deduct. The maximum that you can deduct is 34K plus tax. So that's like how much you can deduct from CCA. Another thing is if you're paying interest on a car, the monthly maximum you can deduct is $300. If you're paying a lease, the monthly maximum you can deduct is $900 plus tax, which equals to $904. Finally, so an employer must always include the value of GST and HST when they're calculating taxable benefits. You can't just be like, oh, the taxable benefit is like $300 when it's actually like $300 plus tax, so like, I don't know, $330 or whatever. Okay, that's it, guys. Bye.